Okay, guys, today we're going to talk about how Elliott Wave Theory I have found to be a representation of the emotional market cycle. Okay, I had seen this image floating around for years, and you know, I kind of took notice of it and said, oh yeah, sure, that makes sense that that's the way the market works. But until I really started putting it together with the Elliott Wave Theory, it started making a lot more sense as to how that's happening. Okay, because in this, that's my biggest thing is that the only way that I learned how to gain in this market is to really study how people were losing and how I was losing and how the market was unfolding. And then I realized that it is an emotional structure that keeps repeating itself over and over again. And most of that is because people are just making wrong decisions and they don't understand the repetitive pattern that like the only thing constant in all these markets is the emotions of the traders and their consistent bad decisions and consistent impatience and lack of discipline and greed and fear, and all of these things are the only things that are really consistent in any market. So it started making sense to me that people were losing money in the market and I was losing money in the market because I didn't understand the way that the market was going to unfold. And when I started studying Elliott Wave Theory, it started making a lot of sense to me because in Elliott Wave Theory, the market's going to unfold in these patterns of like impulse and retrace and impulse and retrace. And if you don't understand the way that the market's going to unfold, you're going to be making those same wrong decisions, and you're going to be, without even knowing it, the biggest one is when people just see things break out and they chase it and they jump in when the price is moving. And like I said before, that's not so bad if you understand where you're at. If you see this breaking out and you chase it and you don't take profit here, then right here, if you hold your position, you'll still be rewarded. But if you don't know that next wave is coming, you might question your trade. You might say, oh, I'm going to cut my losses short. This isn't going anywhere, or I bought at the wrong time. So it's really a mental game, and with your own self, with your own trading. So when things break out like something breaks out like this, the market sees it as, okay, this maybe looks hopeful, and because this thing was in a downtrend for a while. It was in a downtrend for a while. And so what we're looking for mostly is how one market cycle ends or a downtrend ends, and then what we are expecting to come after that downtrend ends. Get rid of this Elliott here. So this was pretty evident, and these are the things that I look for in all these markets. I'll look for, on a higher time frame, I usually start with like the 3-day and then kind of work my way in. I'll look at the weekly for a representation of maybe strength on a bigger picture. But I'll start with the 3-day or the day, usually, and I'll look where the price has been. I'll look at something like this and say, okay, this thing went through a big pump and dump, or a big, market cycle right here. Basically, this whole thing happened on a smaller time frame. Here we're looking at the 3-day, but if you look at the 12-hour, you can see the waves and you can see all these emotional phases that we went through. Let's kind of look at the 6-hour. You can see all the same emotional phases that the market goes through. And so when after something like this happens, you're expecting, okay, once this breaks, you're expecting some sort of a move, some sort of another impulse of some sort. Okay, now when this happened here, there wasn't as much volume and momentum around, and it rallied up, and then it basically went and did a retrace. Now this entire move right here was an impulsive move, but it happened under lower volume, lower market conditions. And this one basically went up to about here. And then we held a retracement, about 61%. But this was in a long downtrend here for about 2 months or so. 2 months or so in here. Yeah, even a little bit, but it's about 65 days or so. This thing was in a long downtrend for a while, and when it broke this line, it was an indication, hey, there's something else that's going to come out of this. There's another impulse, another action that's going to come out of this. So those are the first things I'm looking for, how the downtrend gets broken. And then after the downtrend gets broken, I'm expecting some sort of an impulsive action in the market. Okay? And that usually will come in the form in Elliott Wave fashion. Okay, something very similar to this. Okay, now when we first start playing those waves as they break out, we don't really know what's going to come after. You know, we know that there's a larger move unfolding, but we don't really understand how grand that's going to be until it really starts to show itself. And XMR is a very beautiful example of waves within waves. Okay, like we were talking about recognizing the Elliott wave in the market structure in every time frame. Well, that's because, let's see if I can zoom that. No, it's not zoom. That's because right in here, when we first have a breakout in impulsive action, we have the first little set of Elliott waves. First little set that happens. And then we get the retracement of that. So right here in this small little time frame, we're getting a small little emotional cycle, okay, where the price breaks out, people get hopeful, and then they get optimistic, and then they chase it, and then it sells down, and then, you know, maybe it can't go any further during that moment, so it gets complacent, and then it sells down, and people get, you know, anxious and deny it and panic. But we don't go through all of these phases. We kind of stop about here. Stop about here, because the cycle hasn't completed. It's just the beginning, okay? Just the beginning. Right in here, we kind of stop. And then it gains its strength and continues on. So XMR is a beautiful example of that right here, guys. Okay. And I did not get a new computer yet, guys. And hopefully it doesn't give me as much trouble as it did the other day, because it was not giving me trouble until we started here. All right. So this structure right here in XMR is a beautiful textbook example of Elliott Wave Theory, waves within waves. Okay, we have a first little impulse of action, and then we have a little mini set of waves that we don't know how far it's going to go. Like when this happened here, when this basically happened in here, we knew that there was an impulsive wave that was coming out of this, but we didn't really know just how grand it was going to be, where it was going to wind up. We just knew that it was coming. It was coming, and it was going to unfold in Elliott Wave's fashion. Okay? So this is our first little mini wave. All right? That would be just this one right here. Just this 1 and this 2. Just a 1 and a 2. Now, as this unfolded, we played it, but we didn't really understand how it was going to, how it was going to unfold. I haven't gotten a chance to get off of my mountain here yet, guys, to get to town to get a new computer. So we understood that this was going to unfold here, but we didn't really understand how. And so we play the individual moves for what they are. Okay, like, you know, when this happened, I got in here with my signals guys right here at 125 because I saw that, you know, 1, 2, 3, and that 4 was a good entry. But of course, I didn't really know, you know, how this entire structure was going to unfold. I just understood that we were getting in on a number 4 point of an impulsive wave, and I understood that that was most likely going to be part of a larger wave set that comes. Okay, so that's basically what happened here. You know, this 1, 2, 3, this would be my 4 point that I got in here on Monero. And then we didn't get the clean ABC retracement here of like, whereas this 1 and this 2 move looks like it probably was about 61%, maybe 50. You know, our move right here only held that 38% retracement and flagged up. Did like a really bullish flag right in here, held that 38% retracement. Now, after this, like, this is the kind of thing when you're studying Elliott Wave Theory and you just experience an impulsive leg, and then we hold a retracement, and then we break out again. then you start to realize, okay, you know, we just did a 1 and a 2 this entire leg right up here. This whole zigzag, the 1, 2, 3, 4, 5 was nothing more than just this one leg up. Okay, this one leg up. And our consolidation that we had at the 38%, it didn't come down. It was a number 2, but it didn't come down as far as the example here. You know, this looks like about 61%. We only did about 38% here, but it's still a 1 and a 2 move, meaning that we impulsed and we retraced. And this would be our number 2 move. And then we broke out again. Okay? When we broke out again, we kind of did the same relative action. It wasn't as clean and smooth as this one here. Look at that. It wasn't the clean, this one here was really nice, you know, real nice staircase looking one. It wasn't as clean and smooth looking here. It was a little bit more, you know, we had to kind of search for these. You know, they were kind of hidden in here. Oops. They're hidden in here. We got like a little 1 here, 1, 2, 2, a 3, a 4 that kind of came down, and then a 5. So this was another impulsive little leg in here. Okay, this was basically our 3, our expansion leg, where we came up, we came back down, and then we had a nice expansion, and then we had a retracement that was a light retracement, almost like another flag in here, and then another leg up, and then another leg up right here. Now after that happened, our 4 was pretty deep, okay, on Monero. Our 4 was pretty deep. Our 4 came crashing all the way down to test the top of this. But if you really look at the open and close price during that time, it didn't even come close to this top, okay? So we're going to talk about candles and reading candles and how to use each you know, option that you have. But just to kind of, you know, plant the seed for you guys about how you can use the line chart. First of all, the line chart is just a representation of the open and close prices during that time frame. So whereas the candlestick will, my ghost is back, guys. The candlestick will show us the expansions of price, you know, the large swings. Like that's why we see those wicks, you know, like that wick wicked all the way down and tagged the top of this wave right here. Okay, it wicked all the way down and tagged the top. But in reality, the open and close price during that hourly period didn't even, you know, it was just a quick little, you know, sell-off that happened probably in a 15-minute window. But the time frame did not open and close anywhere in this zone. Anywhere in this zone. Come on. Okay. So when when I study Elliott Wave Theory and I understand that 4th wave that comes down here, it should not infiltrate the price zone of wave 1. Okay, that's our Elliott wave rule. Now it can come down here, it could come crashing all the way into wave 1, but it shouldn't really break that work that's been done, that advancement in price. So that's where people don't really understand, and they'll sell this thing down, and there's like, you know, a lot of panic. You can see that panic in these candles here. You know, this sold right back down here. But understanding Elliott Wave Theory, you're understanding that this emotion of just like fear right here, where people are just panicking to get out, that's your opportunity to get in based on the Elliott Wave cycle. Okay, you have a 1 impulse and a 2 retrace, and then a large 3 impulse. That 4 will usually come crashing down and almost test the top of this wave 1. All right, and then we have a 5th leg that will come after, because it always these things usually always will come in this formation, this Elliott Wave formation. So here, just using that simple Elliott Wave strategy and understanding that after this wave 4 comes down, you're going to get a wave 5. You can kind of play on this idea that right here, right in this area, would be a really good place to buy on the sell-off, because the price shouldn't infiltrate the top of wave 1. So as everybody panics out of this thing and sells it down, and all these people that chase the break right here, you know, a lot of traders right here, well, they won't buy until they see this point break, and then they'll chase this leg up. Well, the price will come crashing right back down and liquidate them and undo all the work that they just did if they don't take their profit off the table. So when the price comes crashing back down, this is a really good place to camp out and, you know, have some buys right here, because then you're kind of, as everyone else is panicking out of the market and being like, oh, let me, this thing reached its top, let me get out of here, and it liquidates people and sells down. You understand that there's another wave to come. So, and the market cycle's new, so there's probably a really, larger wave to come. So just using that simple strategy where you're kind of like, okay, well, we had a 1, we had a 2, we got a nice 3 leg out of there. And this 4 shouldn't really infiltrate the top of this wave height. So let me put my buys there. And when you look after the fact, the price didn't even come close to opening and closing down in this area. So if you would have, set your buys relative to the top of this wave height when you're watching this sell-off and understanding that no matter how much this dumps down right here and people panic, it should not infiltrate the price zone of wave 1. Okay, it should not infiltrate the price zone of wave 1. So if you practice that strategy, you're basically going to pick up a lot of buys in wick areas like this. Okay, this would have been a perfect area to buy people's fear in an area of a wick, even up here. I mean, this whole area right here, really nice place to buy. And what came after that was another wave. This whole thing basically created an Elliott wave here. Okay, down into the box, and then bang, right back up like that. Now, that's what we see here, except this 4 was, our 4 was a little bit more harsh. But when you really look at the open and close price, it kind of makes more sense. Our 4 didn't really open and close down that far. We just could score some fear buys down in there. But our 4 really only came to there, But, when you have that panic and you have that, uneducated trader or people that don't understand, that there's a 5th wave that could come out of this or even a bigger move, people will sell that thing right down into there. And a lot of that, harsh sell-off that you get is a lot of people getting, stopped out or liquidated. So meaning that, if you bought the break right here, if you see that there was a high here and then we're maintained here and then we start to climb and it breaks that high, the previous high, then all the retail traders come in and they'll chase that breakout, or sometimes this makes a cup and a handle and then they chase that cup and a handle. But if they don't take that profit right away in that quick little swing or whatever this time frame was, it was a good amount of time to take profit, honestly. A whole day you had to take profit on that run. But if you don't take profit and you don't understand where you got in, you very well could be one of those people that dumps out right here. Oh, one of those people that dumps out right here, not understanding there's a larger wave to come. Sorry, this tool just won't go away. There we go. Okay. So we're, this is that strategy of just waiting for that patience, expecting, okay, we just had a nice 1 and a 2. This thing's, starting to sell off here. People are probably going to panic. Let me put some buys down here at the top of this wave, really good strategy. And then you catch this wave up, or even, where the price is right now, you're still, sitting at a good place. How do we know when to take profit? Is 0.3. Let's see. Well, when I play the Elliott Wave strategy, I go off of the length of the waves. So if we just had a 1 and we understand that there's another impulsive wave coming, that next impulsive wave has to be usually longer, if not equal to wave 1. So I'll usually just grab a tool like that and then move it like this and say, okay, we're at least going to get a run this big out of it. Okay, at least going to get a run that big out of it, if not longer, because 3 is usually that expansion wave. Now, where this thing will wind up, you can kind of get a little bit of reference sometimes off of previous price action, previous price points. Okay, like for instance, this wave 3 right there, I would have been looking, I would have measured my first wave's length, put it here and said, okay, this could go to about this area. And then I'll look on a higher time frame and say, okay, what are some points of reference during that, price points? Because price has memory, or at least, the psychological acceptance of buying to that level or selling to that level kind of seems to remain the same. Like prices will get revisited again and again. Like, so right, looking for like about right here, that level right there would have been a good place to look for the price to expand to. Sorry, it's giving me way too many lines here, guys. Way too many lines. Okay. So that's how I would kind of know. Like, I would know that third wave coming should be at least the height of the length of the first wave, if not a little bit longer. And, you know, and then kind of consult the higher time frames for previous price points that it could reach to. And that's basically right where that price went to that previous price point. Okay, right? Is that basically it hit it dead on. So I'll always use, like, you know, the expectations of the price to move in the Elliott wave formation, and then, you know, kind of look at the length of the previous wave and measure it off of where we held our retracement, and say, okay, it's going to at least be this long, and if it expands, where are these price points that it could expand to based on previous price points? So that's how I would kind of get that, you know, where price has memory. You know, we'll tie all that together when we start talking about candles and the expansions in price a little bit later on. But, you know, just to kind of plant that seed now, when you see these things running up, they're almost always going to run up to a previous level of resistance or support or interesting price action zone from before, from the past. So now here, okay, this completed a complete 1, 2, 3, 4, 5 Elliott wave on this side, okay, that we see here. Now this is nothing more though but a bigger Elliott wave in itself, okay? This is the purple line, or the dark blue line right there. I guess it's more so purple. But that's more like, that is our larger wave structure that unfolded within Monero here. Okay, we have a larger series of waves that we just did here that we're beginning. Oh my goodness. My ghost is back. It's crazy. This thing does not give me this trouble until I get people on calls. Okay. So we just had this, and then this happen, and I'm expecting it to run up again, which is why, you know, I'm pretty sure most of you guys are on my signals list, which is why I was saying the other day that I'm going to put buys on Monero between 165 and 175, and this is basically the area that got bought right in here on this dump, because understanding that when this correction wave in here, if it's having a hard time holding this the price where it is right here, this is basically the 38% line of the entire move. If it's having trouble holding that line, a lot of the times what it will do is what I did right here in the example, where it like seems like it's holding, and then it gives a little fake out, and then it drops down one more retracement level. Okay, and that's exactly what we got here from Monero. It was like holding this area. We got a little fake out right here, and then it dropped down another retracement level. Now, this is, oh boy. The 50% mark, okay, of the entire move. All right, basically it was holding here at the 38. Right here, you can see on that, just like the example, this thing basically painted a 3 Elliott wave sets in one. You know, we have the sub-minute waves in here, these little ones that we played first. Then we have the larger wave structure that unfolded, which is now creating a larger wave structure. So this really played out to the textbook example of Elliott wave structure, wave within waves. Even to the point here where it couldn't hold the 38% anymore. So it dumped down one more retracement level here to that C point, or number 2 point of a larger wave. And it's kind of interesting because this thing painted that direction the whole time. I mean, to the classic textbook example of it. And then right here, where it couldn't handle anymore and it dumped down one more retracement level, well, that's when Bitcoin started to pump yesterday or the day before. Bitcoin started to go up. And since this is paired against Bitcoin, it started to dump down. So, you know, it's kind of interesting to watch how these things will paint their patterns, and then they'll use certain moments in time when, you know, whatever it's paired against, like this is paired against Bitcoin, so Bitcoin starts to go up. And it will use that moment in time when Bitcoin is going up to actually sell down to its other respective retracement level that it could reach. You know, it basically used that moment to do that little move. When Bitcoin pumped, it couldn't handle anymore, so it sold down to the next retracement level, right there at that 50%, which opened the window there to say, oh, okay, wait a minute, that's where I want to put my buys. Okay, now I had bought in here on this drop right here. I had bought in here at the 38%. And, you know, this is the way, this is the way I play it. You know, I'm really, in a bullish market, I'm really playing that impulsive side because I can understand what might unfold. But the corrective side, we don't really know if it's going to be like how deep it's going to be, if it's going to fall 38%, if it's going to fall 50%. So when I see that it could possibly bounce here, you know, I bought here. And I was in profit all through here. But when it came back down here, it stopped me out of break even. So, you know, that's the way that I play the market to kind of cover myself, would be to take a position in the market, and then when I see it start to move away from my entry, I'll put a stop loss at break even. So if the price does come dumping back down, you know, all I lose on that trade is maybe some trading fees. So, and then you look to get back in, and that's exactly what happened to me on this trade. Like I bought here expecting this thing to continue on, and then it wanted to do more of a consolidation. So it couldn't handle past here, and then it came back down here, and then it tried a little bit to go, but then it dumped down further. So once it dumped down further, I got stopped out at break even and then just reassessed the trade and said, oh, okay, you know, I'm going to buy here on the 50% mark, because that would be, you know, and then I started to realize this thing is really painting the classic, you know, wave within wave Elliott structure. So if we broke that 38, I'm going to look to get in on that 50% mark. And so this thing really did fulfill that perfectly. Okay. So when we're doing the impulsive side, we kind of know more so, okay, this is the direction. We're impulsing up, and we should have some sort of an Elliott wave fashion where we have these little mini waves within waves, and then after we get through that, we're going to get a retracement of the whole move, which is the red move. And then after we get that point, we're expecting something else to come after the entire impulsive leg is done. But after that 1, 2, 3, 4, 5 is done, that ABC retracement correction, we don't really know what it's going to look like. Whereas in here, it was flat. Okay, it was a flat ABC correction that kind of held a 38% retracement and made a flag or a pennant. Over here, it sold down harshly. Okay, this retracement here, this number 4. Oh my goodness, I'm not clicking this at all. Okay, this number 4 sold down harsh. And what happens in Elliott waves, you know, there's certain strict Elliott wave rules. Okay, like the number 2 retracement cannot retrace 100% of wave 1. You know, I've seen it go as far as 88% in cryptocurrency, but that still holds a retracement. You know, it still did make that, you know, small gain in the market. But what you know, so the rules would be that 2 cannot retrace 100% of 1, and that wave 3 cannot be the shortest wave. Okay, those are some really strict, you know, rules. But there's also guidelines that'll come in, and we'll tell you that if you have one wave that's more flat, then the next one will be sharper. And that's kind of what we see here. Like we see our 2 wave in here was pretty flat. There's only a 38% retracement of the number 1 move, whereas our number 4 wave was sharp. It came down, and you know, sometimes we'll tag the top of wave 1, and that's what we saw here in the expansion of price. It basically tagged wave 1 top, and that's what I'm saying. This, you know, playing that strategy, you can get some really good buys on other people's fear right in there. So this one played out pretty beautifully with, you know, the entire Elliott Wave theory. You know, most of the time, if you have 3 be the longest, 5 usually winds up being around the size of wave 1. And this one here is about the size of wave 1, especially if you consider this expansion in price down here. So this is going to unfold and be pretty predictable on the impulsive leg side. Okay, on the impulsive leg side is, when we have a bull market and we're playing this 1, 2, 3, 4, 5 impulse up, it's more predictable as to where our entry should be. We see that one move finish up, we put a Fibonacci tool on there, we say, okay, we're looking for a retracement of that move to get in on a number 2 point. Same thing, if we see the number 3 go up and we understand, okay, it's getting exhausted and it starts to sell down, we understand that that number 4 shouldn't infiltrate wave 1 height, and maybe we could pick up a good area to buy there. Understanding that there's a 5th run to come out of it. Now, this retracement side though, it gets tricky. You got to kind of basically just, play the impulsive side of the market, take your profit, and then just kind of wait for the market to show you what kind of a retracement it's going to get. Which is why, it seemed right here, this point right here, is where the market kind of got complacent. Okay, right here, kind of got complacent in that move. And then we sold down, but we basically held right in that, anxiety kind of spot, and we bounced up. So we're not going to experience all of the emotions until the whole cycle is played out. But as we increase in price and we have these Elliott Wave formations that will kind of, start to go up, like this whole 1 and this 2 move right here, that's a whole little mini Elliott Wave cycle in itself of, people starting to, get that hope, and then they get the thrill euphoria, and then, price comes down, and then maybe goes up a little bit, gets complacent, and then it falls down, and people lose their money, and they get anxiety, and, we probably even feel some anxiety and anger in there too, but it holds a retracement. There's a larger move to come. So the impulsive leg side, you'll experience all of those emotions where people just will chase stuff, and they'll get, they'll really start to believe in it, get optimistic, and then the thrill and euphoria, and then it sells down. And then, oh no, they made the wrong decision, they get out of it, they get anxious, they get angry, maybe they sell at a loss. So that impulsive leg up is pretty predictable. But after that's over, you really just have to wait it out on the retracement side of the larger move. Or play the strategy like I did, where you say, okay, I'm going to catch this bounce on this 38% retracement, and then as it starts to go up in price, let me cover myself with a break-even stop. So that way you're covered both ways. If this thing wants to take off, you're already in position. Your stop loss is at break-even, so that way if it does come back around, you just get stopped out at break-even, maybe lose your trading fees or whatever. That's going to happen, guys. Like, in trading, I would rather get stopped out and pay the trading fees than be holding something at a loss that's going to be a continual loss. The biggest thing in this is there's going to be losses too. I mean, I don't get everything right, so you guys aren't going to get everything right. So you want to always protect yourself with a stop loss so that, you stop, an exponential amount of loss. You have to be able to take little losses that are going to be overshadowed by the large gains that you get, So that would be the strategy here, to enter when you feel like it's a good place, but put a stop at break even, because if it wants to jump down another Fibonacci level, then hey, you get stopped out, right about here on the 38, I got stopped out, but then I looked and said, okay, I'm going to try to get here on the 50, because this entire move, this entire market is pretty bullish. So if we broke the 38, then we're probably just going to tag that 50% mark, which is basically the classic textbook market structure of, sometimes this will take off right here, and just kind of consolidate up and then continue on. Like Ethereum didn't drop down another retracement level. It's a little bit more bullish than Monero. But you have to be expecting those kind of things. And this side is really easy to play. Okay, but like I said, once that impulse is over and you're getting that retracement side, it's really easy to get tricked back into jumping into the market too early. So that's why, I'll kind of like, we'll kind of place my bets in a sense and be like, okay, if it's going to bounce here, at least let me get a seat. And now it starts to move away from there. Let me put my stop and break even. So that way I'm covered both ways. If it continues on, I'm good. If it comes back down, I'm stopped out. I'll look for re-entry. But that doesn't change my analysis on the whole thing. Like, this thing is going to continue. It's going to continue. And that's kind of what it needs to do, because Anybody that bought all in here, including myself, anybody that bought all in this area, they just got shook out, stopped out, or really, questioned their trade. So unless you, trade like I do, where you're like, all right, I put a stop at break even here. If I get stopped out, whatever, I'll just look for another entry. And I did. But a lot of people in here, they don't understand the structure of the market. So as soon as it sells down, or for instance, a lot of people dumped out right here to chase Bitcoin. They don't understand that there's a very good chance they could turn around the next Fibonacci level right there. So this thing here, it did its work. It basically it got everybody all in this area in the green box, impatient, waiting for the price to continue on, getting impatient about it and buying too early. And then it dumped down and shook everybody out, stopped them out, liquidated them, they sold at a loss or whatever. And then right here, we're waiting to pick that up. We're waiting to pick that up on, basically I said 165 to 175, which is basically right there, right there. We got the entry on the lowest point there that this thing should drop. Now, mind you, it's going to continue back up, but it's going to continue back up in waves within waves again. All right, we're not going to get that, just straight shot up to the moon. That's a lot of people, they don't understand, the price, goes to like 190 here and it comes back to 180 and then they're like, oh, is the trade still good? Yeah, the trade is still good. The market needs to move in ebbs and flows. We're going to get the same, now that we continue on here and we're getting that next leg up. Well, that next leg up is also going to unfold in little mini waves within waves, waves within waves. So that's what we're getting now. We're getting our first little mini wave in here, just like this little mini wave back here. Just like this first little one over here. So this first little one right in here. That's kind of like what we're getting right here. Okay. So this thing is going to continue up, but it's going to do waves within waves. It's going to keep repeating that same fractal. And a lot of people don't understand that. They don't understand, they think, oh, okay, it's dumping down or it's not going as fast as I want, or, you just got to be patient. A lot of trading is patience, guys. It really is. It's just like waiting for your entry. And, I've gotten to the point where if I miss my entry, I don't even chase it. I just look for another trade. I mean, really, I just look for another trade. But sometimes that'll burn you where you kind of miss an opportunity. Like if you guys that were trading Ethereum with us, we were waiting for our entry on Ethereum at like 135 and it tagged like 139. And I didn't take the trade again, even though I could have bought at 140 and we wound up getting in on the next retracement. So you'll find your own comfortable style with it. I mean, there's nothing wrong with chasing the price if you missed your entry. Like for instance, if you missed your entry here, then maybe don't chase it on this, but now would be kind of a good time to try to maybe get back in on this little retracement right here. Because what this thing's most likely going to do is it's going to check it. We're getting a crossover here of our strength and our hourly after this little retracement. So this thing's probably going to, get itself together here, get that hourly strength, stochastic RSI strength. Okay, we'll start talking about all the indicators in a couple more sessions, and then it's going to push through this cloud, and then continue on and make another little sub-minute Elliott wave into this third leg. Okay, this is the third leg. So when we're looking at this, we traded this thing all through here and we kind of broke down all these little mini waves that were waves within waves. But what this thing really did was just make a larger Elliott wave opportunity. Sorry guys, let me get all my drawing tools off. I have a phantom in my computer. Okay. So now that we look at this thing, not so much on the 3-day, but let's look at on like the 6-hour. What it painted for us was just a large 1 and a 2 of our Elliott wave. Like that's why getting on here was a good place to get in, because when you look at the bigger picture, we just basically, come on guys, we just basically made a 1 and a 2. sorry, you guys can see what I'm going for here. A 1 and a 2 of a larger move, which is basically this blue line here. Now, we don't see all the little sub-minute waves within waves when we're looking on the higher time frame. We just see the bigger structure that unfolded. So that's really interesting to, to put into your studies, is that there's a lot of sub-minute waves within waves and Elliott waves that made up this entire leg. It made up this entire formation right here. But at the end of the day, if I was looking at this on a higher time frame, I would have looked here to get in as a number 2 point, right here. As a number 2 point of a larger move. And understanding that this larger move to come is most likely going to be larger than that first. Okay, larger than that first. We're at least going to get a move out of this thing to about here. Okay, now we can kind of even get into where will go based on the Fibonacci extensions of the first move. But we'll talk about that when we talk about Fibonacci, because it's not even letting me draw simple lines here right now. Okay, so we want to recognize that the Elliott wave structure that's unfolding is just little psychological mental games over and over again on different time frames. I mean, really, this entire Elliott wave structure that happened right here, or this small little area right in here on an arrow, that was just all of these emotions playing out within, a 15-minute time frame. People chasing it, and then they believe it's going to go, and then they buy too far, and then they get complacent, and then it sells down, and they sell to loss. They get anxious. Maybe they deny it, but it doesn't go through the entire cycle. It'll go through the entire cycle when it's really over. Like once it breaks that certain point, and you're not getting a retracement of the whole move anymore, then you start to get that, the denial and the panic, and just like the whole get me out of this market kind of thing. Sorry guys, my internet connection has been fading in and out here the last couple of days, but not for long, just like a second. Okay, so this is a whole mental game. Every time I see the price move and do an impulse in price, whether I see something break out and I see that big candle come, I just sit back. And I wait and let all the traders do what they're going to do and experience all those emotions and chase the price too far and, get complacent and sell it down. And then I look to get in on the number 2 point. Let the whole cycle play itself out. Let this whole Elliott wave cycle play itself out. But it depends on where you can get in on it. Like obviously on Monero, on the hourly, we were looking at it. So we were getting in on these little sub-minute waves. But this is all just a fractal within a fractal within a larger fractal. And that's the only way it seems to make sense to me. And when I kind of tied it all together was that there has to be some sort of order that is tying all this together. There has to be some sort of consistency that is making these patterns play out time and time again. And then it occurred to me that, well, all right, I understand already that there's a market cycle that is a psychological thing that's taking place. So I understood that, and I always was studying Elliott Wave Theory, but until I put the two of them together, it didn't really make sense. And now that I put the two of them together and been using this strategy for well over a year, it really starts to make sense. It really starts to make sense, because when I had to ask myself and say, well, why does the market keep playing itself out like this? Like, what is it? Is there market makers that are pushing this thing to certain points and playing this thing out? But all these markets are different. So the only real thing that was consistent in every market was the emotions of the traders that are trading. And in mostly every market, whether it's stocks or foreign exchange or anything that you're going to trade, most people are losing money. Like if you do a study and you really research it, like 90% of people lose money trading. Like this is not a winner's game at all. So, and I lost for a really long time until I really started saying, why am I losing? And then then I understood the emotional cycle and said, okay, well, I'm experiencing these emotions. And then I started looking at the Elliott wave structure and said, okay, this emotion that I'm feeling, that when I see this thing break out, oh, I should buy it, I should buy it, I should buy it, and then I don't understand what's going to happen after, and then it comes back down 50% from where I bought it, and now I'm sitting there with a 50% loss, not understanding that I should have bought the retracement, and that there's a bigger picture unfolding. So it really started making sense to me when I started seeing it over and over and over again in every single market. This Elliott Wave structure, it just kept popping out and kept sticking out. Like the market will impulse itself in these waves, and then it will retrace, and it will impulse itself again, and then it will retrace. Now, it's kind of interesting because all of these things are following a numerical order with Fibonacci. And we'll, not the next session, but the one coming after that, we're going to get deep into Fibonacci. But just to kind of plant the seed in your mind now that everything in life and creation flows to that numerical order, to that numerical structure, that harmonious, like, kind of blueprint of life in a sense. So, and it can be applied to the market as well, because these candles that we're looking at, these are just, you know, these are all just representations of human emotion that were felt during that time period, and the print that it leaves on the chart, on the graph. So it's actually measurable. You know, like, we're measuring with Fibonacci tools human emotion. You know, like human emotion here. And even though we just had a lot of little waves, it just wound up being a bigger wave. You know, like this whole 1 and this 2 is what just happened here on like a 6-hour from an arrow. And we're right back to the same place here where our 50% retracement is a number 2 point in the move. But there was a lot of small little cycles of emotion and chasing it and loss and retracement and, you know, fear that led us to this entire structure, you know? And so it really is interesting because it doesn't matter what time frame you play it. You know, you could be playing a 5-minute window and be picking Elliott waves out of that 5-minute window, and you'll really notice how they will impulse, and then they'll get, to the point where they start to fade out, and it's like not enough energy to continue it on, and then they retrace, and then they will push on and continue on again, and it's the same cycle. It's the same cycle. So that's where it just comes back to me, where it just kind of pointed out, well, if this is the same thing here that's happening again and again in every single time frame, then what we're really seeing is just human emotion playing out time and time again. The psychology of the traders and the market, you know, this is repeating itself because 90% of people are losing and they're not understanding. It's like they're fighting against each other to get the right price and to make money in here. And unless they understand the geometry of the market and how it's going to unfold, they're going to take trades at the wrong time. And they're going to get shook out. They're going to deal with the psychological torture of being at a loss. I mean, we all experienced it, you know, like as soon as you buy something and then the price is lower than where you bought it, it's psychological torture. You're sitting there and you're trading. You're like, oh, is this a good trade? Did I get in at the wrong time? Should I cut my losses on this? And especially in cryptocurrency right now, where like everything is moving, you kind of, you know, if you took a trade and you're at a loss and you entered at the wrong time, a lot of people will just abandon that trade and go chase something else and kind of feed that same mentality into another market where they're like, they got into a trade, let's say they bought here and then the price retraces down to here, and now they're sitting here waiting for this thing, you know, to come out of its consolidation or whatever it may be, and they're sitting at a loss because they bought here. And now they're sitting at a loss here and watching other markets go up. And so they're like, oh, well, I just need to get out of this trade, and, you know, they'll cut the losses short and they'll chase another market while it's in its impulsive structure. And then the same repetitive thing will happen again. And then they'll sell at a loss and then probably go chase another market and then look back at this market and say, oh man, if I only would have held that for another day because the price tripled. So, I mean, I'm sure that's happened to all you guys. I mean, it happened to me so many times where I would get into a trade and then it would go into the retracement phase and I would get impatient and I would just kind of bail on my trade to get into another trade. And then I would look back at that graph and be like, oh man, it bounced. And almost like it bounces right after you sell. You know, you almost get like, your impatience gets so drawn out during that retracement phase which is a normal thing in the market. Like even on the higher time frame, this is all a retracement of this larger move. This is a whole big 1 and a 2. This is our ABC retracement on our 2. It's a little bit more clear now on the higher time frame. Okay, a little bit more clear. We got a nice little A, B, C retracement here. Now, after that goes through all of that, this is time. These are larger moves that I'm playing. So the psychology of the trader that bought in here, if you bought in here in this 5th leg, let's say, and then we're down where we're at now, you didn't take profit at the top of the 5th leg or when it was starting to look like it was wearing out or getting expended, then you're still sitting in this trade right now, basically underwater. It's less than where you bought. And that time frame that you're in that, it really takes a lot of patience, because between here and here, we're talking like 10 days or so, 11 days, over a week. So how many people are going to sit in a negative trade for over a week while other things are moving? Not many people. A lot of people are going to cut their losses and not understand that there's probably something larger unfolding. They're going to cut their losses and say, okay, this one's moving. Let me go chase this, or let me go chase that. And, I don't chase anything, guys. Like when things are going up, I don't buy them when they're green. I buy them when they're red. Like that's kind of like the way that I'll do it, unless it's a real quick flip. Like when Zcash broke out a couple weeks ago, I saw it breaking 50. And, I bought some at like 54 and I put a sell order in right at 100 just to see if I could get that quick flip out of it. And I did. I sold, maybe like almost 100% in 15 minutes. But I understood the momentum. You had to, ride that momentum and understand that there's going to be a retracement coming after that. So you have to take your profits off the table. You have to get them out of the market. So there's only certain times that you're going to want to really hold your trade for too long. It depends. Like you could look at this entire market structure unfolding where it broke out here and bought right here and said, all right, I'm just going to hold Monero for 2 months and kind of play that long swing strategy. Or you could play the waves within waves and extract your profit when it's there, buy back in on the retracement, understand that there's a larger move that's unfolding that's going to come. So it all depends. Everybody's going to come up with their own trading style. Me personally, I'll trade the waves. I kind of enjoy hunting down the Elliott waves in the smaller time frames and maximizing them for what they are. Meaning that if you're going to get a move like this in the market that's going to probably go 35 or 40%, with that momentum, I'll try to put in a large amount of coin and ride that wave for what it is. Sorry guys, it's not as bad as the other day, but it's still try to get in and out and ride that that couple day period for what it is and get that 40 to 50% out of it, and then move on, and then pull my money out of the market and wait for another place to get in and kind of do the same thing, rinse and repeat, and it's going to, most of these markets, now you can short Monero, you can short it on margin, but for me, I leave opening short positions for when the market's bearish. I don't really short these kind of waves, because you don't know, I just try to keep it simple. Like when the market is bullish, I'm looking for buy setups and I'm looking for places to buy low and sell high. That's it. And when the market cycle is over, then I'll start looking for places to sell high and then close lower, but I'm not trying to battle the trend and try to guess where the top is going to be and, get in there and short it. And then it goes higher and I get stopped out. It's just, I found, you can pull some pretty good trades out of that. And, I guess if you look at this example, there was an equal amount of money to be made here, meaning that at the bottom here, it went 100% and then it came back down 50. So, you had a chance to get at least 50% out of here if you're going to hold it from here. And if you short it at the top, you got about 50% down, So there's money to be made either side of this, that you want to play. But me personally, I do not short bull markets just because I found myself getting wrecked too many times trying to guess the top or think, especially a margin, because, when you're a margin, you have a very small window for error, because if you enter at one place and then the market comes a little bit higher, you're going to get stopped out, you're going to get liquidated. So, you know, since I'm not going to take a position in margin against this, the only people selling this down are people who actually have the coins. So I'll just wait. I'll get out of the market and then just wait for another opportunity to buy it, you know, to buy it again. And so that's what we did here. You know, we played this thing down here at like 125. Most of it got sold up in here. And like I said, I bought back there at that A point, just in case it was going to continue, and then got stopped out at break even basically, and then re-entered at the C point. And now that C point is actually number 2 point of a larger move. Okay, that is, you know, this point right here, a larger move. Okay, right in there. So now we're just, you know, basically back on the train, waiting for that, you know, third wave to manifest itself, and understanding that that third wave, well, that third wave should at least be as long as that first one, at least as long as the first one. Oops. So we could even just like pull the fib and say, okay, it's at least going to go that far, you know, just as a measurement, you know, it's at least going to go that far, if not maybe further. Because that third wave really likes to expand. You know, when we look at the classic Elliott Wave example, that third leg is always kind of like that longest one that pushes you in expansion in price. So that's why I really like to play the number 2 point in most of these markets, because that number 3 wave is usually longer than that first. So I would expect a move out of Monero here that would at least go to 308, at least, if not probably like 325, based on some other price points that we can discuss in another session. But so just kind of, you know, trying to keep it pretty simple, so that I know this is a lot to digest, and, you know, I'm teaching you guys something that I've discovered in the market. You know what I mean? This is not like, you really won't find, I mean, maybe you will, I haven't found though, anybody that's put the market psychology together with the Elliott Wave theory. There's a lot of Elliott Wave people out there, but I don't hear any talk about how it's related to the market psychology structure. And it really, when I tied those two things together, that really is what made it make sense to me more, because Elliott waves are really hard to digest and kind of understand every little move that they're making. And a lot of people are going to draw Elliott waves in different ways. You know, they're gonna say, oh no, this was number 2, this is number 4. Like, however you see it and you can make money from it and it works for you, do it, because it's just a theory. There's no strict graph that you can put on the market and have it be, you know, textbook every time. Although I will tell you, Monero followed this pattern right here perfectly. Okay, that's one of the rare times that I've ever seen it so beautifully perfect. We're almost like someone programmed a bot to maintain certain Fibonacci ratios. And but then again, you know, then it's kind of like you're kind of saying that there's a greater force behind that's making these things happen, when I really think it's nature, it's natural law. You know, it's like human emotions and how it can be measured with Fibonacci numbers, to kind of give you the I guess the divine blueprint, in a sense. So like, you know, like when I say divine, I just mean like of creation, like not so much, you know, everyone. The thing is, when you start researching this, it will lead you down all, you know, rabbit holes. You know, it's just kind of interesting for me. Like I've studied like esoteric teachings and like, you know, cycles of life and like mastery of life and time and cycles with like, you know, Masonic order and Rosicrucian order and things like that like deep sciences of the universe. And in those studies, there's also harmonic order with Fibonacci and how things grow and decline in life in cycles. And then when I saw it in the markets, it kind of tied together all my earlier esoteric, you know, studies into something that made sense. And I don't know, maybe that's why, you know, I pieced the puzzles together the way I did. But it seems to make sense to me that there is some sort of natural flow of the universe that is showing itself in the market. And that natural flow is the measurability of human emotions. Okay, so I know it's a little bit outside the box, and it's not like the mainstream, way that people are looking at the market. But I'll tell you, to be able to make money in these markets, you have to think outside the box. Like, you really do. You have to think outside the box, because any mainstream channel of information that's going to say, oh, this line means this and this line means that, and use this indicator for this, and it's, most of it doesn't really work. Like, I traded for years off of, trading strategies based on indicators and this, that, and the other thing, and they only work like, 40% of the time. And so the only thing that I found was consistent over and over and over again was that emotional fractal, was this Elliott wave that's appearing in smaller time frames, larger time frames, and then even larger time frames, and then even bigger time frames. Like when we can look at the monthly chart for gold. I mean, the monthly chart for gold, we're looking at a large, huge cycle, an emotional cycle that took a long time to play out. Let's see here, guys. This thing is just trying to stop my little ghost here. Sometimes it works. Let's see. This weekend, guys, I'm definitely going to get another computer. I know I said that last time, but I have not gotten off the hill. I live like in the jungle in the mountains in Costa Rica, and sometimes I'm just too busy to get to town. So let's look real quick over here at gold, because I want to show you guys how. Wow. Come on. If we can, come on. All right, gold. Now this is just a larger Elliott wave, guys. Just a larger Elliott wave that took a long time to play out. And we're experiencing, like, all of these. This is what's really interesting about this, is that we're seeing this emotional pattern that humans are kind of leaving behind on the chart. We're seeing it in all time frames. Whereas here on gold, it's kind of the same thing. I'm sure, I can almost guarantee you, if you were to take this leg right here and this whole market structure that we see right here, if you were to take that and break it down into, hourly time frames, you'd be seeing waves within waves. Okay, you would be seeing all these little mini waves in here that made the larger leg on its way up, and all these little mini waves that made the retracement and the correction wave. But what's interesting is that it plays out on so many time frames that we could see it in, like, when we just looked at Monero, those little mini waves were waves within waves and Elliott wave cycles that made up that larger leg. Okay, but here was something with gold. This entire emotional cycle took years to play out. Years. So that's when I found it really interesting, because I was like, well, here we have something that took from this point in time all the way, let's say, till it finished here. We're talking like, 581 days. Okay, what's that even? Was it more? Let's see. Maybe even more. But it took a long time. Okay, it was a long process before those emotions were felt. Okay, and then when it continued on, it created another market cycle. Okay, now this is very similar to what I think that Bitcoin is going to do, except Bitcoin moves a lot faster. Like where the weekly chart for Bitcoin looks like the monthly chart for gold, in a sense. So, but what I'm trying to display here to you guys, without all this ghost action here, is that these time frames, you're going to see it repeat. You're going to see fractals within fractals within fractals within fractals that just keep building and keep building and keep building in this structure, in this form. Now, sometimes it's not, in Monero, it's really clean. I mean, you can pick out those little sub-minute waves, and you can pick out the black waves, the red waves, and the blue waves in Monero right now. But that's because we're still looking at this, the whole blue wave in sections. We're looking at it where we can look at the 15-minute or the hourly, and we can see the black waves. And we look at the, maybe even still on the hourly right now, we can see the black waves, the red waves, and the start of the bigger wave, okay? But when you look at the bigger chart, now when we look at the 6 hour on Monero, you don't even see anything except the blue wave. And then when this entire thing is up, like, so right now in Monero, we just did a 1 and a 2 of a blue wave. Now when that 3, 4, 5 and the retracement come, you won't even see that structure on the 6 hour. You'll have to look at like the weekly chart to see how the whole market cycle completed, you know? So it's really a matter of like trying not to get lost in your waves within waves, okay? And just playing each wave for what it is, and understanding that when you see something that looks like it broke its market cycle, like, you know, for instance, like gold here, when it broke here, it started a new run, okay? Just like Bitcoin, when it broke, it started a new run. It's like Ethereum, when it broke, it started a new run. But it's all going to like happen in different time frames. Those Elliott waves are going to form in different time frames, to the point where maybe a year from now we look back at Ethereum on a monthly chart and we start to see larger waves unfolding. You know, we start to see that, because with Ethereum, oh nice, Ethereum's up at 5250, just about over 500 again. Yeah, Ethereum is going to run, guys. Ethereum is going to run. Let's see. All right, here. Now here with Ethereum, you can see like we completed a market cycle, and now when we look at the 3-day, we're starting to see a larger picture unfold here. You know, we're starting to see this entire leg up that we have right here. This entire leg up right here. On the 3-day, it's just starting to look like our huge leg up. But when we look at it on like our hourly, we can see the waves within waves. We can see the structure that it's forming. So this is like the only way I can really make sense of it to, like, you know, explain it to other people is this graph. This graph is golden right here. Like, this is the golden key right here, guys, is that all of those big waves, even this big monster leg up right here for Ethereum with the green line on it, even this right here, this is nothing more than smaller time frame waves within waves unfolding. And those waves within waves they're unfolding to create a larger Elliott wave structure, a larger psychological market structure. Okay? They're just going to take their good old time to play out. Okay? They're going to take their time to play out. Sorry, I'm trying to get this green line off of here, so you guys can see a little bit better there. Okay. So this entire, like, you know, looks like a straight shot up when we're looking on the 3-day. You know, it doesn't look like there's very much structure in it at all. But what we're doing in that big straight shot up is we're forming waves within waves on smaller time frames. Okay, smaller time frames. We're forming waves within waves. So this is what the leg up right here really looks like. Okay. Now it doesn't look so, you know, straight up to the sky when you look at it like this, especially when you put a trend line on it and you can see that it's been following this trend right here. I'm not going to try to draw the line because it'll probably make me draw it like 5 times. But you guys can see this thing is following nice on a trend. Okay, nicely on a trend right there. So we have to understand when we're studying the Elliott Wave Theory that there is, especially when we see a break in market cycle on a larger time frame, we have to understand there's a larger move unfolding. Okay? There's a larger move unfolding, and have to understand that that move that unfolds is going to unfold as waves within waves. All right. Now, like I said, we could have a buy and a hold strategy where basically you see, okay, right here, and when this volume went in and it broke that downtrend and we started looking at Ethereum at like 140, 135, you could have just, you know, played this strategy where you're like, okay, this thing on a higher time frame broke its market cycle and is now going to create another huge grand Elliott wave, another huge market bubble. Let me just market buy a whole bunch and just hold it. Just hold it and just wait. You know, you could have just market bought Ethereum on the breakout like 2 weeks ago and just held it, knowing how the market's going to unfold, knowing the structure of the market and what's expected. Or you could play these waves in and out. play these waves in and out where, you buy on the breakout or you buy right there where you see, and then you start to see that first wave start to, come to its end, take profit. And then you see it going through some sort of consolidation zone in here, okay, right in here, some sort of consolidation zone, and break out, buy again. Or, buy at this point when you see that this, about that 38% retracement right in here, okay, and buy again. So there's all sorts of ways that you guys can play this. Like, I like to swing trades in and out. And I'm also, providing trade opportunities for, over 50 people now. So I want to really study these waves and say, okay, if you guys, if I don't want to just tell everybody, hey, buy this now and hold it, because then there's all that time in between that people are like, oh, am I going to make money off of this? I'm not. I want trade opportunities, to trade weekly. So you could trade these. Once you discover this and you understand how this is all going to play out, you can trade these from all sorts of different perspectives. You can just do the whole investor style buy and hold strategy. You could do the, play the waves like we play, where we try to, play these sub-minute waves, just wait for the impulse. Watch that impulse. The impulse comes, just sit back and let all the retail traders and all the emotions of all those traders leave the print on the chart, and let everybody else do all the work for you. And then boom, now you have a small little impulsive move that you can put a Fibonacci tool on, and you can say, okay, it broke out here, it went to here, I'm going to look for the retracement here, that's going to be my number 2 point, let me buy at the number 2 point. And that's almost the simplest trade that you could get, just by exercising some patience, some discipline, and not falling prey to the emotions that all the other traders are falling for when they see it break out. Because when they see it break out, they just chase it, and that's what makes it really, all that volume come in, and then, then it gets to a certain point where people don't want to buy it anymore. And then it'll sell down, and people will take profit. You let the whole market go through that. You don't even have to take part in it. Just sit back and watch. So, okay, Ethereum broke out. Okay, Monero broke out. Okay, let's see, Zcash broke out, whatever it may be. You can just literally watch the chart and say, okay, it broke out. Like, I wait for things to break out. Like, I mean, if you guys notice, I talked about Coin. Most of you guys are on my WhatsApp list. So, if not, just I'm explaining the time that a market review video I showed. But basically, in that one, I said Coin is getting ready to break out. If it breaks this cloud, it's most likely gonna shoot up. But we didn't. When it broke out, you guys notice I didn't send any trades for it yet. I still haven't sent any trades for Coin yet, even though it's on my list, and I'm waiting for the opportunity to tell you guys to get in it, because I understand it went through that breakout, and it still has a lot of resistance to work through. So I'm waiting for all that, impatience to come out and all this to happen until I see that nice number 2 point present itself, and then we're going to get into Coin. Okay? But we want to let the market do what it's going to do. Let the chart, let the graph print for us, so then we can measure it and say, okay, this thing broke out. It went from, for Coin example, I think it went from like 42 to like 64 or something. And then we wait to get back in on that retracement. Okay. We don't want to chase anything, guys. We don't want to chase anything. Let the market do what it's going to do. Let everybody else experience all these, let everybody else go through the thing where they're like, oh, it's breaking out, I'm optimistic, and then they believe, and then the thrill and euphoria comes, and it sells down, and then they get complacent, and they think it's going to continue, and then it sells down more, and then it hits, maybe about this like anxiety or denial point, and then it stops and gets a retracement. That's when we want it. Okay, we want it after it's gone through all of the emotions, and everybody else just gets washed in and washed out, and they lose money. That's when we want it. That's when we want it, at the number 2 point. Okay, so for my strategy, it's understanding that this is all a psychological, emotional game. Like, you really have to trade like a robot, and not let that fear of missing out take you on a bad trade, because it happens to all of us. We see things break out, and we're just like, oh wow, this is going up, I should buy this. No. Like, it's the opposite. Like, when you see things breaking out, oh, this is going up, I should buy this. No, don't buy it. Wait till everybody else loses money on it and the price comes crashing back down. but you understand there's a bigger picture unfolding because it broke a market cycle or it's a new impulsive move. Most of the time, when you see a 1 and a 2 happen like this, there was a period of accumulation before. So things aren't just going to accumulate and break out to the moon. Although XBC did this week, I mean, it went up like 2,000%. But I'll tell you guys right now, stuff like that that's going on Poloniex, don't fall for it, okay? There's no technical analysis reason for those coins to pump at all. At all. Like literally people just have money now that they've made and they're just buying these coins because there's a limited supply and they're just pumping them. I mean, literally, it's not hard. You could take 400 Bitcoins and just buy a lot of all these altcoins and then basically hold the price at 1,000% and get everybody to chase it, and you're just offloading coins to those people. And then if you notice, XBC is almost all the way down to its breakout point. So when you see stuff like that, don't chase it, guys. Don't chase it. Those are like pump and dump traps. Even though you could have bought the retracement of that at like 400% and still profited, you have to know the kind of trade that you're getting into. Like I look for structure in the market, and most of the time you're not looking at the graph when it's at a flat line before the 1 and the 2 impulse. Okay. So just let the market do what it's going to do. When you see it break out like that and it create a strong impulsive 1 move and then it's starting to get that, retracement, then you really start to analyze the market to get in and start to say, okay, this thing looks like it could continue further and it's going to create an Elliott Wave structure. Let me get in here at this number 2 point. So just let the market do what it's going to do. Like you see something break out, let it break out. Let everybody chase it. Let everybody go through all of these little bit of emotions up until the about anxiety point. And then it should hold a retracement and continue on. We're only going to get the full market cycle after the whole thing has completed itself. Okay? That's what I really want to point out to you guys, because here we kind of get the whole market cycle, but it kind of ends at like anxiety. It really didn't bleed all the way down to, denial, panic, capitulation, and anger. We didn't get all of those emotions out of a move like this because we understand this is just the beginning of the impulsive move. This is just part of the leg of a larger time frame. Okay, this is just part of this could be a 1 hour chart we're looking at here, but when we look at it at a 3-day, we don't even see these waves within waves. Okay, so we have to understand that there's a larger picture unfolding, and we are kind of playing the macro or the micro moves within it. Okay, so there's a larger macro move happening, but we're playing those little micro moves within it, understanding that those moves are leading into larger moves. Okay, so you don't want to fall prey for those, for that, the chasing of anything. Like I said, when I recognize a market has broke its market structure and it's going to go up and it's a bullish market, I buy it when it's red. I don't buy it when it's green. I buy other people's fear because I understand, hey, this thing broke out. There's a bigger picture unfolding. We got Elliott waves. They're going to unfold here. The same emotional structure in the market is going to unfold. So let the traders do what they're going to do. Let them do it. Let them paint the chart for me and paint that 1 and the 2, and then bang, I get in on the number 2. Number 2 is the safest trade that you could take. Number 4 is the second safest, but you have to understand, that 5th wave is probably going to be about the length of the first one. So if you get in on number 4 point, it's just kind of like a quick in and out, unless you're really trying to hold that position for a larger move. But you can see here, even if you got in on number 4, by the time it comes down and does a retracement of the whole move, you're, at negative in your trade. So that's why, number 2 would be the best place after and that's not hard to spot. I mean, it just takes a little bit of patience to just say, oh, you study the market, you look at the graph, you say, oh, this broke out. Okay, look at how good this broke out. All right, and then you just watch it. Let everybody push it to those expansions in price and to that top of that number 1, and then and then it sells down, and that basically leaves that print on the chart for you to measure. And you say, okay, this is what I can expect out of this emotional move. And so we'll get into that when we talk about Fibonacci's in the next one. Or no, we're going to talk more about market structure in the next one. But when we talk about Fibonacci's, basically that first impulsive emotional move that you want to stay out of the market and you want to let all the rest of the traders do and get on the number 2 point, that first emotional impulse in the market leaves a measurable print that you can put a Fibonacci tool on and see what possible extensions in price could happen based on that first emotional move, okay? And then you just let the market do what it's going to do. I mean, it really is, once you figure it out, it's not that hard. A lot of it is really just not letting yourself become your own enemy. I mean, really, like you having a real strict, disciplined trading style and saying, hey, I'm not going to chase that. Yeah, that looks great. Everybody, even if it goes here and it breaks out at that, breakout point in that first number 1 leg, even if it goes 100% in price, who cares? Who cares? Just let it go. Let it go. Buy it when it's 50% back down. Because when you start to see things that they're going up 50, 70, 80%, then your mind starts to be like, oh man, I could be making money off of this, and maybe I should get into that trade. You just got tricked by your own self, So just wait. The market plays itself out the same way, guys, over and over and over again. I'm sure you realize that, like, when you see an impulsive move in the market, it doesn't reward the people that chase it. It just doesn't. It rewards the people who are patient to get in on the retraces and the people that understand where to get back out. Now, I would have bought a number 2 point here on any of these coins, Monero, Ethereum, and just, you could just hold. You could just basically hold at that point because there's a bigger picture unfolding for these. And, it's going to take time. But what happens is once these market cycles are initiated, they usually play themselves out, especially with, like, I really see some really big things happening here in cryptocurrency right now because this is the only thing I've ever traded where the price is determined by how many there are. All right, you could trade foreign exchange all day or stocks or whatever, or futures, but all those contracts and all those things, it's an unlimited amount of that you could take into a trade, and there's lots of liquidity and lots of market cap in those. But with cryptocurrency, the price of every single one of these coins is determined by the market cap divided by the available supply. And all of these coins, whether it's 3 million that Radium had or like 16 or 20 million that Bitcoin has, they all have a limited supply, meaning that as more money comes into these markets, they are going to go up by default, just by default, because supply and demand. The more money that comes in, the higher the price is going to go. So these market cycles have now been initiated. They've broken out from old trends, like almost everything, even Ripple broke out. And we saw that coming too after it broke out at like 500, and it still has to work its way, but it could very well get up, 2,000, 2,500 Satoshis again. But it's going to take time. The whole market needs to go through that ebb and the flow and go through this, entire wave within wave cycle and work its way through the resistance. But once this is initiated, it's most likely not going to stop, guys. Like, there's more, and that's why, okay? Because when things break out like they're breaking out now, and they start to go up in price, and people start to see, wow, this thing went up 100%. Wow, this thing's up 80%. Wow, this is up 200%, and it's maintaining its price for the last 2 weeks, up 200%. Then it draws the crowds. It really draws the rest of the dumb money that will chase it higher, because that's what this whole market is feeding off of. It's feeding off of greed. People's greed to be like, oh, that thing's up and it looks like it's going to go higher. And so they'll keep putting their money into it. So now that all these coins are going up, it's getting the worldwide attention. I mean, the amount of people that have come into cryptocurrency in the last month, it blows my mind. I mean, that's why I'm moving this whole thing onto a larger platform with, a back office where, we can have live trading sessions and we can have educational sessions and even an auto trader, because the time is right. Like, so many people are coming into cryptocurrency now because they're seeing this increase in price. And this increase in price is going to remain pretty steady on its way up, because by default, there's only a certain amount of these coins. And that's why those coins are so easy to pump on Poloniex, because if you got some money, you could easily just buy a chunk of them at, you know, whatever it is. I mean, XBC, how it went over 2,000%. I'm sure that somebody bought it up, you know, 300% higher than the market price when they got in, but they bought all of that up 300%, and then just kept putting money in the books to keep supporting it, and then put a bot on there. So the bot's just spamming the order books with all these little buys and sells and kind of getting everybody hyped that there's a lot of action going on. And then basically, you know, they just hold the price up and then just start selling into the crowd, start selling into everybody's greed, you know? We need a chat area for students. We can help each other learn. Yeah. I mean, that's definitely coming. You know, I didn't put everybody on the WhatsApp in a group just because WhatsApp has everybody's phone numbers, and, you know, a lot of people in cryptocurrency like to be really anonymous, and I didn't want everybody having everybody else's phone numbers, obviously. But I'm creating a Facebook group that's going to be like a public group, more like kind of like, you know, just based around, you know, my strategy, my company that I'm building, Bits to Freedom. And that's going to be like a public group where everybody just kind of can, like, you know, get a little bit of, get some crumbs, you know, kind of get around the campfire and get an idea of what's going on. But for all the, you know, WhatsApp guys and stuff, we're going to eventually have a website where everybody comes in. There's going to be a chat. There's going to be a place where I post alerts in there, but they also get broadcasted to whatever channel. I'm going to try to find what works better. We could still use WhatsApp or whatever. But yeah, I want to get all you guys too together to you know, kind of, you know, iron sharpens iron, you know. So get you guys together so we can keep building on this and help each other out. But I don't want to do it where everybody has everybody else's phone number, because I kind of want to respect everybody else's privacy and stuff. So you know, that's the only reason that we're not all grouped together right now, because I want to group everybody together when there's more of a like, you know, whether it could be through maybe a Slack chat or a Telegram chat or something like that, you know. So we're getting there. You know, this, honestly, guys, this has exploded on me. You know, like, I've been doing this. I mean, a lot of you guys have been following me for a while, and I've been doing this strategy for a while, and I've been giving trade alerts on Twitter through email for over 2 years. But now it's really exploded to the point where there's too much interest. You know, it has to be more organized on a platform rather than me just forwarding or broadcasting WhatsApp messages to you guys. So that's what I'm working towards, and it's in the works. You know, we got some, you know, I've been spending the last couple of days on calls with developers and trying to get all this worked out. And my business partner, he's handling the marketing and the whole everything. So this is really going to come together pretty soon, within the next month. So, you know, I look forward to sharing that with you guys and really laying out the trade opportunities here, because there's a lot of opportunity in cryptocurrency here, guys. There's more opportunity in cryptocurrency and more money to be made without as much risk in cryptocurrency right now than there is in Forex. Even though in Forex you can make a lot of money in a trade. But for instance, in Forex, if you get in, like, let's say here at this point, thinking it's going to continue at that little A, and it doesn't continue and it falls down to the C, you're wiped out. You're liquidated, you're wiped out. Maybe your account got drained if you didn't have a stop loss. I mean, it's rough. It's rough. It'll chop you out quick. But in cryptocurrency, you know, if you bought there, unless it's a leverage trade, but if you bought there in a spot market at like the A point and it drops to the C point, you're just kind of holding those coins for a minute until they come back around. And if you understand the market cycle, you can say, okay, yeah, I understand this has to retrace further. It's going to come back around. Let me hold on to these coins and not be at such a loss. And then get, you know, another 40, 50, 100% move out of the next move. Whereas in Forex, you know, people are just getting chopped up, spit up and chopped out left and right. You know, and I this strategy works in Forex, but you have to play it on almost like a 5-minute and just really play the sub-minute waves and take your profit when it's there and be thankful for it and walk away, because it'll chop you out on the next move if you misjudge the next move. I mean, cryptocurrency is a little bit more forgiving. You know, we have, you know, it's just more forgiving. You know, there's a lot of money to be made, but with a lot less risk of loss, basically. So that's really attracting a lot more people. And like I said, more people that come, the more this is going to keep manifesting itself, guys, because this is all the limited supply on all these things. You know, it really is limited supply on everything. So let's finish it up here today. You know, I just want to really express to you guys that this emotional structure can be found in every time frame. All right, that's why I just let the market do what it's going to do. When I'll just wait for that number one to manifest itself and look to get on the number two and let everybody else experience all of that thrill, belief, euphoria, complacency, anxiety, selling at a loss, and then boom, we look to enter on everybody else's loss. Because that's the only way, you know, like, I don't feel bad morally about it. You know, someone asked me before, do I feel bad morally about it because, you know, you're taking from people when they're losing? But hey, man, we're all playing this game of trading, and some of us, you know, just refine our skills more to win. And, you know, so for every trade, there's going to be a winner and a loser. So that's it. You know, like, you know, I lost for a long time, and now I don't lose anymore. So, you know, it's like simple as that. You know, like, you got to develop a strategy where you start winning in the market. And, you know, the reality is the only way that you're going to be winning is by winning from other people's loss. So sad story for the 90%, but when you become the 10%, you, that's the way it works, you know, and eventually those people will either figure it out, get shown like you guys are being shown, or they'll just quit. You know, I quit trading two times, like, and the third time I actually quit 3 times, but the third time I knew, I was like, I just kind of couldn't let go. You know, I said, I know there's money to be made in these markets, but I got scared. Honestly, I got scared because I could not risk to lose. Okay. Like, I couldn't risk it. Like, I live in Costa Rica. I left the United States behind. I live here. I have a family. I got 3 kids. So you know, it needed to work for me to trade. It needed to work, but I was scared because I couldn't risk to take, I couldn't afford the risk to have that loss. So it took me a while to get back into it. And, you know, I'm glad I did, obviously, but I think that everybody needs to go through that cycle of loss to understand how they're losing, because it's the only way. Eventually, if you lose enough times, it's going to click in your mind and say, man, I'm not going to make that bad decision again. I'm not going to do that again. And then when you combine all that with a good strategy, risk management, discipline, patience, then it really starts to work. Okay, guys? So that's it for today. I got to get some breakfast here before I have a student in an hour. But I'll catch all you guys on, let's see, Wednesday. I'll catch you guys on Friday. And hopefully you guys are getting something out of this. If you have any questions, hit me up on WhatsApp with them or through the email or something. And that way I'll just kind of start on Friday and hit you guys all up on the questions, because I noticed that when I click out of here in the chat, it doesn't always save the chat info. All right. So, and check your inboxes. I'm going to send you guys a copy of today's session in a couple hours after it processes here on the site. So until then, guys, keep stacking the Bitcoin, man. Keep looking for those trade opportunities and enjoy trading for what it is, you know, profitable and free, you know, a way to be free. Take care, guys.